All right, guys, let's start. So now we are doing your chapter number 21 of your operational risk book. The chapter is your capital regulations before the global financial crisis. Okay, this reading, right, sets the historical foundation for why Basel I and Basel II look the way they do, right? It is less about formulas and more about your regulatory logic, evolution, and limitations. There are two modules here. Module 1 is about your Basel I regulations and revisions. The module explained how your capital regulation started, what problem it was trying to solve, and why it later proved insufficient, right? So that's what we'll try to do. And module 2 is about your Basel II regulations, right? So that we'll try to understand. Okay. So let's dig deeper. Let's try to understand in a much detailed way, logically, chronologically, right? And understand the logic behind it. Okay. Perfect. All right. So module 1 is further subdivided into 14 topics, right? First is your overview, then the need for Basel regulation, then BCBS creation, Basel Committee for Banking Supervision creation, capital and risk-weighted assets, two capital components, RWAs, risk-weighted assets for on-balance sheet items, risk-weighted asset for off-balance sheet items, trade exposure method, original exposure method, 1995 amendment of netting, 1996 amendment of market risk and trading activities, 1996 amendment of standardized approach and your internal model approach, 1996 amendment for market risk war for internal model approach, and then 1996 amendment for backtesting. All historical steps, one by one, we will study all of them. Fine. Moving on. Perfect. Right. Now we are getting into your topic one, which is the overview. Basically, since there's a lot of theory, guys, I'll try to give you the crux. Right. Basel I came in 1988. Basel I introduced the first formal risk weighing system for banks. Prior to this, capital requirements were mostly simple leverage-based ratio. Right. So Basel I established the idea that capital should be held against your risk, not just against your total assets. However, Basel I only addressed your credit risk, ignoring your market and operational risk, right? Then came the Basel II. Basel II had expansion, right? Basel II broadened your risk coverage to include your credit risk, your market risk, your operational risk, and it introduced your more sophisticated methods, especially your internal models. This evolution, right? This evolution to include your market risk and operational risk and more sophisticated methods recognize that banking risk is multidimensional in nature and not just your loan default risk, right? For the exam perspective, please understand students are expected to understand what Basel II added related to your Basel I, distinguish between your different risk calculation approaches, understand why your internal model exists and why regulators are cautious about them, right? Then we'll compare, then we'll kind of compare Basel II versus Solvency II. Basel II applies to your banks, right? And your Solvency II applies to your Solvency II applies to your insurance companies, right? So that we need to understand very clearly. And both are risk-based capital frameworks, but operate in different industries. Confusing the two is a common exam trap. The consequences of your breaching Basel standards, firms breaching capital requirement face regulatory intervention, restrictions on growth and dividends, loss of market confidence. Students must be able to calculate your required capital and understand your implications of the shortfalls, right? Then we go into your standardized versus your internal approaches. Standardized approaches are more simpler, used by less sophisticated institution. Internal approaches are your firm specific, more complex, often result in lower capital requirements. This trade-off is repeatedly and appears repeatedly throughout your Basel II, right? And then there are internal approaches and capital reduction. Internal approaches allow banks to use your proprietary risk estimate, account for diversification and correlation, and this often leads to your low required capital, which is why regulators impose your strict approval and governance requirement, right? So that is what we need to understand. Fine. Okay, perfect. Then we get into your topic number 2, right? When we try to understand topic number 2, then that topic is need for Basel regulation. This topic explains why regulations were necessary at all, right? So when you look at your early banks, right? Early banks or early signals of your bank soundness, historically, what has been seen, right? Historically, bank signal safety through your large capital buffers, impressive physical buildings. Those were signals, not guarantees of your solvency, right? Then came the private sector monitoring. Early oversight came from your institution like your Bank of England, your clearing houses. Your monitoring relied on your shared financial information and your peer discipline. And the failure of private monitoring was that private monitoring proved insufficient during your crisis. Systematic failures revealed that individual incentives did not align with your system stability, and this led to your public sector regulatory frameworks, right? There were banking panics and lender of last resort. Banking panics caused sudden withdrawals, large losses. Government had to rely on central banks as lenders of last resort, with many uh, looking at central banks as the money creation authority, right? There were macroeconomic consequences. Financial crisis caused recessions, your depression. Government revealed that bank stability is macroeconomic stability, and there was requirement of transparency and consumer protection. Banks customers struggle to assess the bank safety, the safety demand increase for your regulatory oversight, transparent capital standards. And then there were your international trade and globalization, expansion of international trade, which happened from 1960s onwards, increased cross-border banking increase, systematic interconnectedness increase. This made national-only regulation quite inadequate in nature, right? And then we understood the global systematic risk also. Large multinational banks created spillover risk. Failures in one country could impact many others simultaneously. And then there was regulatory arbitrage. Banks in highly regulated countries gained cost advantages. This increased your capital migration, your risk concentration, and coordinated regulation was needed to prevent a race to the bottom. Right. Then you look at the settlement risk and the Herstatt Bank, time zone and currency differences increase your settlement risk. Herstatt Bank's 1974 collapse highlighted the danger of uncoordinated international settlement, and this event directly influenced your global regulatory cooperation, right? So that is what we need to understand. I'm not highlighting much here, guys, because there's too much of theory, right? I just want you to understand these points. uh, it's a story kind of chapter, the evolution, how it happened, right? So just listen to me. I think that will add more value because I'll try to give you the logic behind it, right? Then we go to the BCBS creation, basically the formation of banking committee for bank, Basel Committee for Banking Supervision. The Basel Committee on Banking Supervision was formed in 1974. Right, members included your G10 countries. The objective was coordination, not enforcement. Pre 1988, right, from 1974 to 1988, capital regulation problems were observed. Capital rules varied widely across countries. Simple ratios like capital to assets were used, assets to capital were used, ignored your actual risk profiles of banks, and there was uneven enforcement, right? Different regulators applied your rules differently, and this created your uneven competitive conditions internationally. Then there was off balance sheet growth. OTC derivatives such as your swaps, such as your options, expanded very, very rapidly from the 1960s onward. These exposure did not appear on your balance sheets, escaped your capital requirement, and total assets became a poor proxy for your risk, right? And then the risk composition also differ. Banks with similar total assets could have very different risk profile. This reinforced the need for risk-weighted measures. And Basel I, which came in 1988 BIS Accord, right, introduced the first international risk-based capital standards. BCBS had no legal authority. Implementation relied on your national laws. There was domestic adoption. Countries adopted Basel I through your national legislation, your regulatory rules, and this decentralized enforcement remains a defining feature of your Basel standards. Okay, so that is what happened in your BCBS creation. Okay, moving on. Next one was your capital and risk weighted asset. So there was a key innovation. Basel I shifted focus from capital total assets or the total assets by capital easy ratio to capital by risk weighted asset. So three capital requirements came under your Basel I. One was total assets to capital ratio. Capital by total assets should be greater than 5%, equivalent to assets to capital ratio less than 20% or 20, right? Not the 20%, 20, right? Similar to pre 1988 leverage constraint, there was tier one capital requirement. When you look at the tier one capital divided by your RWAs should be greater than your 4%. RWAs included on balance sheet item of balance sheet exposure designed to capture credit exposure more accurately. Then there was a total capital requirement, tier 1 plus tier 2 divided by your RWAs should be greater than your 8%. Tier 2 capped at 50% of total capital, and excess tier 1 above 4% could count towards your total capital, right? So this was the requirement. Again, you have to remember these rules, guys. These are like how these things evaluated. These were the rules which were formed by the Basel committee. Has to remember, right? There is no other choice than that. Then we move to your topic 5. Topic 5 is about two capital components. Tier 1 is your obviously your tier 1 capital is obviously your core capital, which includes your common equity after deducting your goodwill, your non-cumulative perpetual preferred stock. Key role is to understand the primary loss observing capital. Tier 2 capital is your supplementary capital, right? That we need to understand includes your cumulative perpetual preferred stock, certain long dated debentures, 99 years, subordinated debt with original maturity greater than 5 years. Key role is to absorb your losses after equity, and it is subordinate to your depositor. Then you need to look at the loss absorption hierarchy. Tier 1 absorbs your losses first, tier 2 protects your depositor during failure. The hierarchy is central to your capital quality discussions, right? Then we have the composition constraint. Minimum 50% of total capital must be tier 1, at least half of tier 1 must be common equity, ensure sufficient high quality capital. And then there is some kind of national discretion also. Some country imposed your capital requirements above Basel I minimums. Basel standards for floors, not the ceilings. That has to be kept in mind, right? So overall, till now, what you have understood is that Basel I was a landmark shift from your crude leverage ratios to risk-based capital, but it was still very, very simplistic in nature. Its limitation directly set the stage for Basel II's complexity and model-based approaches, right? So now, once we have understood this, then we go into your risk-weighted assets on your balance sheet item, right? So, continuing in the same understanding, right? We are now focusing on the next topic, which needs introduction of topic 1 to 5, which we had, right? So, topic 6, which is risk-weighted assets for on-balance sheet items. What RWAs mean in Basel I is that risk-weighted assets convert a bank's balance sheet into a risk-adjusted measure. Each on your balance sheet asset is uh, assign a regulatory risk weight meant to proxy your credit risk, not market or operational risk. And this reflects your Basel I philosophy that not all assets are equally risky. So capital should depend on your asset type. How your RWAs are calculated for each asset. RWA is nothing but your exposure into risk weight. Typical Basel I risk weights, when we talk about 0% for cash, right? Which look at the table, 0% for cash, gold, OECD, sovereigns, the US Treasury, insured residential mortgages, 20% for your claim on OECD, banks, government agencies, 50% on uninsured residential mortgages, and 100% on corporate loan, consumer loans, non-OECD bank claims, right? These weights are coarse and bucket based, which later became a key criticism of your Basel I. If you look at one of the example which is given here, right? The assets of the Blue Star Bank consist of $20 million in US Treasury bill, $20 million in insured mortgages, $50 million in uninsured mortgages, and $150 million in corporate loans. Now, when you use the risk weight which are given in the table below, right, you calculate the bank's risk-weighted assets. $20 million US Treasury bills will have 0% weight, $20 million insured mortgages will again have 0% weight, $50 million insured mortgages will have 50% weight, and $150 million corporate loans will have 100% weight. So calculation is 0.0 into 20, 0.0 into 20, 0.5 into 50, 1 into 1.1 into 150, and the value comes at 175. The key takeaway here is that even though total asset is 240 million, risk adjusted asset is 175 million, which is what capital requirements are applied to, right? This is what is the primary understanding here, right? Please keep in mind, total assets were $240 million. Risk adjusted assets was $175 million, which is what capital requirements are applied to. Okay. So this was for your on balance sheet item. What about off balance sheet item? Okay. Now, when you talk about the off balance sheet item, please understand that the Basel I recognized that the credit risk does not rely or does not only sit on the balance sheet. If you look at the credit equivalent amounts, right? Off balance sheet exposures are first converted into your credit equivalent amount, CEAs. This is done using your regulatory conversion factors. Uh, Conceptually, if you talk about how much credit exposure would this look if it were on the balance sheet, that we need to understand. And that's a two-step process. You convert off balance sheet exposure into a CEA, which is nothing but your what you say credit equivalent amount, right? CEA is your credit equivalent amount, and apply risk weight based on the counterparty. RWA is nothing but your CEA into your risk weight. So if you look at the conversion factors, right, for the Basel One, 100% for your guarantees, your banker acceptance, loan like 50% for standby letter of credit, 20% for loan commitment greater than equal to 1 year, and 0% for loan commitment for the less than 1 year, right? Higher conversion factor means higher likelihood the exposure becomes real, right? The example which is given here, right, in the slide is that it is a $200 million standby letter of credit, right? Standby letter of credit, and it's a to a government agency would first be converted into $100 million credit equivalent amount. Why? Because $200 million standby letter of credit to government agency conversion factor is 50%. CEA is equal to 200 million into your zero point 0.5, which becomes your 100 million. Risk weight is 20%. The risk weight, when you multiply RWA, you try to calculate 100 into zero point 0.2, which is your 20 million. And then you look at the derivative versus non-derivative exposure also, right? So that we need to keep in mind that when you look at non-derivative, you use conversion factors on notional. When you use derivative, you use your special exposure methods, which will come ahead in the next topic. We'll try to understand. So that is our understanding of your derivative and non-derivative, right? Next is your current exposure method, which is specifically for the derivatives. This topic addresses your OTC derivatives, which Basel I treated separately due to mark-to-market volatility, potential future exposure. The core formula here was that your the CEA method, right, which we saw earlier, right? This is basically CEA for derivative. The CEA is equal to max of V comma 0 plus D into L. V is the current market value of the derivative. D is the add-on factor, regulatory percentage, and L is the notional principal, right? You look at the economic interpretation, max V comma 0 is the current exposure if counterparty defaults today. D into L is the potential failure exposure over remaining life. And negative MTM values do not reduce your exposure. Then we have add-on factors, depends on your instrument type, your remaining maturity. Interest rate swaps have low add-ons related to equities or commodities. And you look at the example, the interest rate swap, if it is your less than 1 year, it is 0%, 1 to 5 year, it is 0.5%, and it is greater than 5 years, then it is 1.5%. And you have a table in front of you, right, that you can understand, right? For example, if you, let's say, take the interest rate swap, right? Interest rate swap, when you try to calculate, let's say, your notional is 175 million, remaining maturity is 3 years, current value is 2.5 million, add-on is 0.5%, right? So interest rate is, if the remaining maturity is 3 years, it will come into your 1 to 5 years. So it is add-on is 0.5%, and from CEA, right? The current expo, the calculation of CEA to your RWA, you apply the counterparty risk weight. For OECD bank, you will apply 20%. For corporation, you will apply 100%. So OECD bank RWA will become what, right? It will become your 0.675, right? And for your corporation, RWA will become your 3.375. Why? Because the weights are different, right? So total bank RWAs will be nothing but you are multiplying your on balance sheet RWAs, or basically you are summing up the on balance sheet RWA plus the off balance sheet RWA, and then you try to calculate the whole thing, right? So that is what is the understanding. And when you look at your Basel requirement, Basel I required that your capital should be greater than 8% your RWA, and that's what we need to keep in mind very clearly. Okay. So that is the calculation part, right? You can see here, I think the calculation is given in a lot of detail. Uh, the add-on factor is 0.5% of the IRS, right? So this is $3.375 million. The nature of the counterparty depends that, OECD bank or the corporation, OECD bank 0.20%, corporation 100%, different values, understand on balance sheet and off balance sheet are added, that you need to understand. And eventually required capital is your sum of two things multiplied by, and you need to have your capital which should be greater than 8% RWA. So 175 plus 3.375 into 8%, which comes out 14.27 million, right? So keep that in mind very, very clearly, guys. This calculation looks a little tricky, but it's not that difficult, right? So please understand very, very clearly that Blue Star Bank has increased or entered a 175 million interest rate swap with a remaining maturity of your 3 years. So obviously the current value is $2.5 million. You calculate the swap CEA, right? You take 0.5% as per the table. Your 2.5 into 0.5% of 175, 3.375, because this is the add-on factor, right? Then from CEA to RWA, how do you move? Your 20%, 100% of, depending on the counterparty risk weight, right? That you do, and then you add it, and that's what we are doing. And finally, on balance sheet RWAs or balance sheet RWAs, you calculate and you multiply with your, what you say, the total RW, right? Total RW you will get 175 plus 3.375, and you multiply by 0.08 by 8%. Capital is 8% required of the total RW, right? So that is what is the calculation. Go back and see it, guys. I think that will help you to understand it more. Fine, not very difficult, right? Very, very simple in that sense. Okay. Fine. Once we have this understanding, we are doing the practice question here. Michigan One Bank and Trust has entered a $200 million interest rate swap with the corporation. Corporation 100% weight interest rate swap. You understand, right? The remaining maturity of the swap is 6 years, so we are in more than 5 years. The current value of the swap is $3.5 million. Using the table below to find the add-on factor for the interest rate swap, the equivalent risk-weighted asset RWA under Basel I is closest to what amount, right? So numbers given are IRS notional given to us is $200 million, remaining maturity 6 year, current value $3.5 million. Counterparty is corporation. Now, what is the step one? Step one is identify the add-on factor. How do you identify the add-on factor? You take the maturity, right? You look at the maturity greater than 5 year. The maturity greater than 5 year, your interest rate swap, the value what should be used, the value you should, as per the table, is 1.5%, right? So you try to compute your CEA. Now CEA, if I have to compute the current value of the swap is $3.5 million, you have to add on this, right? So it is 3.5, and then you have to apply your 1.5%, meaning 0.015. And what is the notional? Notional is $200 million, right? So 200, right? You solve it, it becomes 6.5 million, right? Then you apply the risk weight, but it's a corporation, right? 6.5 into 100%, so it becomes 6.5, right? So this is your RWA. Now, once you have got the RWA, I think the question is asking equivalent risk-weighted asset 6.5. So answer is D, right? So please understand, Basel I basically treats your derivative conservatively, no netting benefit. Chorus add-on bucket. This lack of risk sensitivity is exactly why Basel II and later Basel III kind of evolved. Okay, fine. Moving on, guys. Next one, which we are trying to understand now, is that we are trying to continue in the. I think this is already done, so we don't need to worry about it. Now we'll talk about your original exposure method, right? When you talk about original exposure method, what this method is, that original exposure method is an alternative to the current exposure method. For calculating your credit exposure on derivative, very limited in scope, allowed only for your interest rate and your foreign exchange contracts, not permitted for your equities, not permitted for your commodities, neither for your derivatives. Please remember that. Okay, there are key simplifications versus your current exposure method that we need to understand. The current market value V may be ignored. This is a major simplification to your CEA. Your CEA was your what? CEA is your max V comma 0 plus D into L, right? So where we have original maturity or remaining maturity of the contract, this makes the method less risk sensitive. That is why it was gradually phased out. There were add-on factors which are given in 62.4 table. The add-on factor depends on the type of contract. If it is FX or interest rate, maturity M, interest rate contracts, if less than 1 year is 0.5, 1 to 2 year is 1, and for greater than 2 year is 1 plus 1 into interest M minus 1. Foreign exchange contract less than 1 year 2%, to 2 year 5%, greater than 2 year 5 plus 3, int m minus 1, int x is a closer integer to x. The key intuition you should have here is that original exposure method is much simpler, less conservative, and less accurate. Basel later favored your current exposure and your war based approaches, but this is what also came in between, right? So that we need to remember. Okay. Fine. After this, now we are trying to understand the amendments which happened, right? So 1995 amendment, which was for the netting. The problem with original Basel I was that Basel I penalized your hedging, right? Each derivative leg attracted your capital independently, so no recognition of your offsetting position. The netting concept under the ISDA master agreement, right? Positive and negative MTMs can legally offset. On default, bank loses the net exposure, not the gross positive exposure. And what the 1995 amendment actually changed was that they allowed your uh, capital relief when a legal enforceable netting arrangement exists, reduce your credit equivalent amount CEA, right? So that is what they did. And there was a formula net replacement ratio NRR, which was nothing but your current exposure with netting divided by current exposure without netting. Why do we do it? Because we are trying to measure how effective your netting is, and similar NRR, right? Your net replacement ratio, greater capital relief. And then we have modified CEA max of your V comma 0 and your 0.5 J, 0.6 DJ into NRR. Interpretation is 40% of add-ons are always charged, 60% are scaled down by netting efficiency. And if you look at the whole idea, right, the whole idea is that netting reduces your RWAs, encourages your risk management, was a major structural improvement over your Basel I. So that is what happened in 1995 amendment for netting. Then we get into your what you say 1996 amendment, right? 1996 amendment for your market risk and your trading activities. See, what was missing until 1996 was that Basel I focused almost entirely on the credit risk, right? Did not capture the market risk from trading books. Now, 1996 amendment introduced your mandatory market risk capital applied to your trading book assets. And when you look at the trading book and banking book, right? Trading book are generally what? Trading book are things which are held for short-term trading. Mark-to-market accounting includes your bonds, equities, commodities, FX, most of the derivatives, right? Then look at the banking book. These are held to maturity investment, historical cost accounting, including your loans and debt security. And there are definitely two approaches which were introduced. One was a standardized measurement approach, SA, and one was the internal model-based approach, IMA. Both require your separate capital charges for specific risk, SR, which is issue specific, and general market risk, MR, broad your market movements. So that we need to understand very, very categorically. And then if you go ahead, right, we need to understand now the 1996 amendment for your standardized approach and internal model approach. Standardized approach, if you look at standardized measurement approach, it was regulatory defined rules, no diversification benefit, correlations were ignored, typically used by a smaller bank, less sophisticated risk function. Then came the internal model based approach. Banks developed internal war models, must meet your strict regulatory capital derived from your war outputs. And why IMA usually give lower capital? Because it recognizes your correlation, it recognizes your portfolio diversification, but still conservative due to multiplicative factors or your backtesting penalties, right? So war coverage versus your specific risk. Please understand, war captures your interest rate risk, your FX risk, your equity index risk, your commodity risk. War does not capture your credit specific risk or credit spread risk and your firm specific equity risk, right? Specific risk, SR, right? That charge handle these things, right? Specific risk, right? So there was a requirement of tier 3 capital, right? That was introduced specifically, right? Tier 3 capital was introduced specifically for market risk, short term insubordinated debt, which is greater than or equal to 2 years, and later removed under your Basel III, right? So that is what was done in your 1996 amendment of standardized approach and internal model approach. Then came the 1996 amendment for market risk war. IMA model, the regulatory war requirement was your 10-day time horizon, 99% confidence level. Market risk war formula was your max of war t minus 1, comma m into war average. War t minus 1 was previous day war average was average war over last 60 trading days, and m was the multiplicative factor, right? Then you look at the capital linkage here. Market risk RWA. Market risk RWA is nothing but 12.5% into market risk war. Total capital is equal to 0.08 into your credit RWA plus market RWA. You look at your previous war, which was $10 million, average war $8 million, m is equal to 3. Then you calculate your, if you have to calculate your MR war, right? Market risk war, right? You have to calculate, right? So that is, nothing but, this is the example which is given here, right? So $10 million, 62, 8 million, multiplicative factor is 3, right? So it is 0.08 into market RWA, which is nothing but 0.08, and you take what? You take the 12.5 times the market risk war, 12.5, and what is the market risk war? It is 3 into 8, right? Why into 3 into 8? Because multiplicative factor into 8, the market risk war is your 24, right? So, and why we are multiplying 12.5 times? Because some of the Basel I credit risk capital and the new market risk capital, for simplicity, the RWS of market risk capital was defined as 12.5 times the market risk war, right? So for market risk capital calculation, right, we have to do 12.5 times this part, and 3 into 8, 24, and then you have to take 8%, right? So this is what was the this what was the calculation. Okay, you have to know this formula, right? There's no way you can progress without knowing this formula. Fine. Moving on. Next one is your understanding of your 1996 amendment of backtesting. The backtesting requirement, if you understand, compare 1 day 99% war against your actual profit and loss over last 250 trading days, right? If you look at the exception, uh, occurs when actual loss is greater than war, multiplicative factor m. You look at setting. If the less than 5 exception, m is equal to 3, right? If it is 5 to 9 exceptions, your m increases gradually. If greater than 10, m is set equal to 4. There is supervisory discretion here, right? A regulator may consider your position changes, your model deficiencies, your pure market shocks, which are bad lucks, right? So that can be considered, right? So there is exception regarding multiplicative factor, performance based penalties that we consider. Okay, moving on, guys. Next is your practice question. Saugatuck National Bank uses the internal model-based approach to set your market risk capital as prescribed by the 1996 amendment to the 1998 Basel Accord. The bank has backtested 99% one-day wars against the actual losses over the last 250 trading days. Based on the result of the backtesting, the bank recorded 11 exceptions, which is more than 10, right? Based on this result, the multiplicative factor in the model should be set to what, right? See, exception greater than n, m is equal to 4, right? So correct answer here is equal to 4. So keep that in mind. Overall, the big picture, the takeaway for the FRM part 2 is that Basel I was only about credit risk. 1995 netting recognition was done. 1996 market risk, war, and backtesting was done. These flaws and fixes directly leading to your Basel II and Basel III, which you will see repeatedly in your FRM part 2 questions, and you will see repeatedly in your next few chapters also. Okay, all right. So this completes our, module one, right? This completes our module one. We have done this answer, so I'm not repeating. I've explained you already, right? So this completes our module one. Now we are getting into your module two, which is your Basel II regulations, right? We'll try to understand Basel II regulations. Fine. Now, when we talk about a Basel II regulation, again, there are 11 topics here, so quite long. This one also, we'll try to understand the Basel II overview. We'll try to understand Basel II Pillar 1, which is minimum capital requirement, then Pillar 2, which is supervisory review. Then we'll talk about your credit risk capital requirement, right? Then we'll talk about your credit risk capital requirement, standardized approach, in internal rating based approach, advanced IRB approach, so foundation, advanced IRB. So see, credit risk capital requirement in standardized IRB, advanced IRB, foundation versus advanced IRB, right? For retail exposure, for capital requirements, solvency two framework. So quite a detailed structure, right? You will go a deep dive into something and you will try to understand the differences between each approach. Standardized internal rating based approach, advanced internal rating based approach, foundation IRB, advanced IRB, retail exposures, supervisory review, minimum capital requirement, everything in detail, right? So let's go and dig deeper and understand these. Okay. Now, when we talk about your Basel II, right, what you need to understand first and foremost, right? First and foremost, try to understand that this particular module 2, is a direct response to the weakness of Basel I, right, which you have already covered initially, right? Basel II refines how much capital bank must hold and how risks are measured, supervised, and disclosed. And we look at the first topic, which is the Basel II overview, right, where we talk about the Basel I limitation, right? So we are talking about that under Basel I, right? Under Basel I, all corporate loans carried a 100% risk weight, regardless of your credit quality. AAA rated borrower and a C rated borrower require the same capital, which is atrocious, right? This created your poor risk sensitivity, regulatory arbitrage, and no recognition of your diversification benefit. Basel II was designed explicitly to fix these shortcomings, right? Basel II development timeline, if you try to understand, it was proposed in June 1999. Proposed. Published in June 2004. So proposed to publish 5 years. Implemented in June 2000, implemented 2007, not June 2007, implemented 2007, right? So again 3 years, right? So 8 years have passed only in proposed, publish, and implementation. The scope was applied primarily to your internationally active banks, not intended for your small domestic banks, right? There was some exception, regional bank exception. Many small US regional banks stayed under your Basel 1A, which was a very Basel 1 like framework. European banks broadly adopted your Basel 2, and this explained uneven global adoption despite the global intent. Right? There is three pillar structure in Basel 2. Basel 2 is basically your built, right? Basel 2 is built on your three mutually enforcing pillars. One is a minimum capital requirement pillar, pillar one. One is supervisory review pillar, pillar two, and one is market discipline, pillar three, right? These three pillars ensure that capital is calculated properly, which is pillar one. Risks not captured in formulas are addressed properly, which is supervisory review, and market discipline banks via transparency, which is pillar three, right? The four key innovations of Basel II was that there was more risk-sensitive capital formulas based on your internal risk measures that reflect your modern credit risk management. There was explicit capital charge for your operational risk in addition to your credit and market risk, and there was a formal supervisory review, which was part two, right? Sorry, the pillar two, which was capital adequacy beyond your formulas and greater disclosure and your transparency, which was pillar three, supported by your quantitative impact studies QIS to refine the framework. We'll study all this ahead, but just have an idea that QIS was part of Basel two pillar three, right? And your specific requirement supervision was part of pillar two, right? So that we need to understand. Okay, once we have understood this now, right? The next thing we need to understand is your topic two, which is your Basel two pillar one with the minimum capital requirements. The core idea here is that your capital requirement should depend on the credit quality of your counterparties. This is the single biggest shift from your Basel one risk coverage. If you talk about under pillar one, right? If you look at it, credit risk is basically redesigned using your ratings and your IRB approaches. Market risk unchanged from the 1996 amendment. Operation risk new under your Basel II. And when you look at the capital ratio, banks must still hold your total capital is equal to your 8% of the RWAs. So the 8% rule remains, but RWAs are now more refined. And then you look at the total capital rule, which is given here. Total capital rule is equal to 0.08 or 8% of the credit risk RWAs, market risk RWAs plus operational risk RWAs, right? The key takeaway here is that Basel II did not raise the headline capital ratio. It just changed the how the RWAs are computed, right? You included a better formula of credit risk plus RW plus market risk RW plus operation risk RW, right? So that is what we need to understand. Okay. Moving on, the next one is the understanding of the Basel II Pillar 2 supervisory review, right? See, ultimately, objective was what? Objective was the global consistency goal. Okay. Basel II aims for consistent capital standard across internationally active banks. Avoid your capital shopping across your jurisdiction. There was a regulatory discretion. Pillar 2 explicitly allows your national supervisors discretion. Local regulators can adjust your implementation, reflect your country specific risk, your impose your higher capital if needed. So that was present. There was enhanced risk management, means supervisors must encourage your stronger risk governance. They assess risks not fully captured under Pillar 1, such as your concentration risk, your interest rate risk in the banking book, liquidity risk, strategic, and your reputational risk. And then there was a ICAP requirement that banks must implement your internal capital adequacy assessment process, ICAP. ICAP require banks to assess their own capital needs, reflect their specific risk profile, go beyond your regulatory minimum. And Pillar 2 basically recognizes that models alone are never sufficient, right? So that's what we need to understand. Okay. Then we look at your pillar four. Pillar four is basically Basel II, pillar two market discipline. So uh, basically, actually, this is not pillar two, this is pillar three, right? So this is pillar three. The goal of the pillar three was uh, increase transparency, right? Enable the market participant to assess the bank's riskiness and use disclosure as a disciplinary mechanism, right? So what are the type of disclosure we need to have? We need to have the qualitative disclosures, means disclosure of the corporate structure, risk management framework, quantitative disclosure, right, which is capital level, risk exposure, risk measure. Underlying logic is that if shareholder and analysts understand the bank risk, they will price risk correctly. Banks will manage the risk more prudently. Then there was a disclosure flexibility, which we need to understand. The bank decide what is material, what is relevant. Supervisors used disclose data to conduct your you know QIS, right, quantitative impact studies. Fine tune your Basel II repeatedly, that was required. And according to your Basel II, bank should disclose all these factors which are listed. The mandatory disclosure include your scope of Basel II application, entities covered under that, details of capital instruments, composition of tier 1 and composition of tier 2 capital, capital requirements for credit risk, capital requirement for operational risk, capital requirement for your market risk and other material risk, and structure and operation of the bank's risk management function, right? So that we need to cover in your pillar 3. Okay, market discipline. Okay, then we look at your credit risk capital requirement. Now when you talk about the credit risk capital requirement, please understand that uh, it is basically about how Basel II credit risk is calculated, or what are the approaches, right? Banks can choose among your three approaches, right, depending on the sophistication, right? One is the standardized approach, one is the foundation internal rating based approach, and one is the advanced IRB approach, right? Standardized approach is basically using your external credit ratings, regulator defined risk weight. Foundation, IRB, FIRB, bank estimate your probability of default, regulator supply other parameters. Advanced IRB, bank estimate your PD, LGD, EAD maturity, most risk sensitive and your complex, right? If you try to link to your earlier topics, please understand these approaches are directly aligned with your pillar 1, pillar 2 reviews whether banks are using them appropriately or not, and pillar 3 ensure transparency around the usage, right? So overall, what we have studied till now is that Basel 2 is not exactly about your more capital but better capital, right? It integrates your quantitative models, which is pillar 1, your supervisory judgment, which is pillar 2, and market discipline, which is pillar 3. And this structure set the foundation for your Basel 3 refinements, which address your systematic risk and pro cyclicality, right? So that's what we need to understand. Fine. So we have covered till now, and okay, then we go ahead, right? The next topic, right? If you look at the next understanding, right, now we need to build or understand the credit risk capital requirement under your standardized approach, right? First of all, who uses the standardized approach? This approach is designed for banks with relatively less sophisticated internal risk management system. Conceptually, it is an evolution of Basel One, not a complex overhaul, right? The key difference from Basel One is that risk weights are no longer uniform. They now depend on your external credit ratings, right? That we need to understand. And this sets the stage for your Basel Two's broader goal, making your capital more risk sensitive without forcing all banks into your complex internal model. What were the key changes under Basel II standardized approach? So OECD status, right, no longer important. Under your Basel One, exposure to OECD countries automatically received your lower weights. Uh, Basel II removes this shortcut. Credit quality matters more than your geopolitical grouping. making the framework more economically meaningful. There was role of external credit ratings. Risk weights now depend on ratings of countries, banks, and corporates. High rated entities attract low risk weights, and low rated entities attract your high risk weights. This directly corrects your Basel I's flaw, where AAA and C rated borrowers were treated identically. There was a home country discretion. Supervisors may allow low risk weights for exposure to the sovereign with the bank is incorporated. This reflect your regulatory realism. Domestic sovereign exposures are often treated more favorably due to monetary and fiscal backing. Right. Then we look at your sovereign versus bank rating. Regulator may choose whether a bank's risk weight is based on the bank's own rating or the rating of the sovereign where the bank is domiciled. This matters particularly in your emerging markets where sovereign ceilings can dominate your bank ratings. Then unrated versus your poorly rated, a subtle but important point. Unrated does not mean high risk. Poor rated exposure can attract higher risk rate than unrated one. This prevents penalizing entities simply because they lack a rating, right? The short maturity concerns also. Supervisor may assign your low risk weights to claim with maturity under your 3 months. Short maturity implies lower exposure to credit deterioration, hence lower capital, right? And if you look at your retail and other fixed weights, Basel II standardized certain retail exposure 75% for your unrated retail, 35% for unrated mortgage, 0% for cash, and 100% to other, right? So all these points which I have listed are very, very important because these are the significant changes which happened. And objective was to create a method which was simplistic and consistent for similar or common banking product. That is what we are trying to understand, right? So there was also, if you look at it, right, if you try to understand the collateral adjustment in the same part, right? We're still continuing with the standardized approach, guys. So collateral adjustment under the standardized approach, please understand there is a simple approach, there is a comprehensive approach, there is a revaluation requirement. If you look at a simple approach, the collateral risk weight replaces the counterparty risk weight for the covered portion. Any uncovered exposure continues to carry the counterparty risk weight, right? A minimum 20% risk weight applies to a collateral. This approach is conservative and easy to apply, but not very risk sensitive. Then we have the comprehensive approach. This is the most or the more widely used method. Instead of replacing a risk weight, it adjusts your exposure upward and adjusts your collateral value downward. And adjustments reflect your volatility in both your exposure and collateral. And this approach captures a market risk embedded in your collateralized transaction, which aligns better with real world risk. Then we have the revaluation requirement. Regardless of approach, collateral must be revalued at least every 6 months. This ensures collateral values remain realistic and prevents your capital understatement, right? So that we need to understand. Okay. Now, with this, let's go and do some questions, guys. Now, so let's do question number one. Bank McTawa has a $150 million exposure to Holland Metals company. The exposure is secured by $125 million of collateral consisting of AA plus rated bond. Holland Metal Company is unrated. The collateral risk weight is 20%. Bank Makatawa assumes an adjustment to the exposure of plus 15% to fallow for possible increase in the exposure and allows for a minus 25% change in the post value of the collateral. I think it's for follow, right? Risk weighted asset for the exposures are closest to what? 78.75, 93.75, 118.13, 172.50 million. Right. How do we need to proceed here? Right. See, first you do what? Right. In this case, first step is you adjust the exposure and collateral. When I say adjust exposure and collateral, basically what we are doing is exposure increases by 15%, right? So what we'll do is 1.15 into your 150. So that brings me 172.5, and collateral decreases by 25%. So 0.75 into your 125, right, which is 93.75, right? So this is the first step. Second step is to calculate the net exposure. Net exposure we have to do is equal to 172.5 minus your 93.75, which brings us 78.75, right? Then you apply the risk weight, right? Risk weight in this case is counterparty is an unrated, right? The risk weight is 1, right? So 78.75 into 1 is equal to 78.75, right? So correct answer here is your 78.75, right? So adjust exposure and collateral, first step. Second is the net exposure calculation. right? Third step is obviously you apply risk weight, right? RW risk weight. Okay, so that's what we do. I think that will give you a clean idea what is the requirement here. Okay, fine. So this is done, guys. Now moving ahead. So this is, I think, the calculation, right? Same logic. What I have done, you use it. You apply the risk weight 78.75, right? So I think that is what we do. Okay, fine. Okay, next one is basically now we have to understand the credit risk capital requirement, the IRB approach, right? See, when you talk about the US implementation, right, what you need to understand is that Basel II, in the US, Basel II IRB, internal rating based approach was applied only to your large banks. Regulator mandated your IRB usage rather than allowing your choice, right? Why? Because this there was a concern, right? This reflects your concern about your model consistency and regulatory oversight. And then we move to the conceptual soundness of your IRB. Capital is based on 1 year loss at the 99.9% confidence level. A very beautiful example or graph is given. This represents a severe but plausible stress scenario. The model framework is regulatory prescribed, not fully bank defined. And then we look at the expected losses versus unexpected losses. Expected losses what? Expected losses is regular predictable losses covered through your pricing, provision, and margin. And then the unexpected losses is extreme losses beyond your expected losses covered by your regulatory capital. So Basel II capital targets unexpected losses only. Then you look at your stress losses. Losses which are beyond the 99.9% VAR are treated as your stress losses, and these are not required to be covered by your capital, but addressed through your stress testing and buffers. Then you look at the capital definition. The capital required is equal to capital is equal to value at risk minus your expected losses. This is the conceptual bridge between your economic capital and your regulatory capital. Okay, that we need to understand very, very clearly. Okay, then once we have this understanding, what we need to do is that we need to look at the Gaussian cupola and your default rate 99.9. Default rate at 99.9% represent the worst case default rate at the 99.9 percentile. The model assumes a large diversified portfolio defaults driven by your common systematic factors. There's a role of correlation. You can see here in the formula. Higher correlation means higher joint default risk, higher default risk at your 99.9%. Correlation is zero. Default risk 99%, 99.9% is equal to your probability of default, right? This highlights why your systematic risk drives capital, not your idiosyncratic risk. And then, if you look at the probability of default, is the 1 year probability of default to the ith obliger given a large number of obligers, and correlation is the cupola correlation between each pair of obligers, right? Okay. Now, once we have seen this also internal rating based approach, right? What we need to do is that when we try to calculate your portfolio level capital approximation, right? 1 year VAR is equal to VAR 99.9%, right? Is basically the summation of EAD, LGD, and default rate and 99.9, right? And capital is equal to VAR 99.9 minus your expected losses, right? This aggregation relies on law of large number, assuming your portfolio granularity. Please understand that probability of default and the correlation relationship, that Basel II embeds an inverse relationship. As probability of default increases, correlation decreases. And if you look at the interpretation, high quality borrowers default mainly due to systemic shocks, low quality borrowers default due to idiosyncratic reasons. And then you look at your what you say your maturity adjustment. Why maturity matters? Because longer maturity imply greater exposure to credit deterioration. Your If you look at your MA scale, right, which will come ahead, right, to be fair, right? So if you go ahead, right, so what we see here is there is something called maturity adjustment. Uh, why maturity matters? Because longer maturity imply greater exposure to credit deterioration, and MA scales capital upward for longer term exposure. Then the formula, if you look at it, there is if maturity is 1 year, M is equal to 1. For longer maturity, MA is greater than 1. This aligns capital with your credit migration over time. And then we do the calculation for your RWAs, where RWAs is nothing but 12.5 into your capital, and capital is nothing but EAD into LGD into DR 99.9 minus PD into MA, right? And please keep in mind 12.5 is why we get 12.5, because it is 1 by 0.08, right? What is 12.5? 12.5 is nothing but what? 1 by 0.08, na? That is what we are talking here, right? So this is how Basel II translates your economic capital logic into your regulatory RWAs. And if you want to keep in mind, right, please understand that standardized approach is very, very simple, rating driven, conservative approach. IRB approach is a model based, forward looking, uh, approach, right? So that is what Basel II's innovation lies in separating your expected losses from your unexpected losses. IRB approach is focusing on unexpected losses, and you are trying to align the capital with extreme credit events, not your average losses, right? So that is what we are trying to achieve. Okay, fine. Once we have this understanding, now we are going into your topic number 8, right? Topic number 8 is the credit risk capital requirement under your advanced IRB approach, right? Please understand, now we are trying to dig deeper and get to know the relationship between foundation IRB and advanced IRB. Conceptually, if you talk about your foundation IRB, FIRB, and advanced IRB are built on the same capital formula. The only real distinction is who provides the risk parameter estimate, bank versus supervisor. This distinction reflects your regulatory trust in the bank risk model. In your foundation IRB approach, your probability of default estimation, the bank estimates the PD, probability of default, subject to a floor of 0.03% for bank and corporate exposure. The floor prevents banks from understating your credit risk for very high quality borrowers, gaming the capital by overly optimistic probability of default. When you look at your LGD, your loss given default, your exposure default, your maturity, these are set by the Basel committee, not the bank. Standard supervisor LGD, loss given defaults are 45% for senior unsecured claims, 75% for your subordinated claims. If collateral exists, right, LGD is reduced using the comprehensive collateral approach, which we saw earlier in the topic, right? Then, if you look at EAD, calculated similar to your credit equivalent amounts, EA under Basel I includes your net yield, includes your credit conversion factors for off-balance sheet items. This ensure continuity, which comes from Basel I to Basel II, right? And then we look at the maturity part. Maturity is typically fixed at 2.5 years, right? This simplifies your capital calculation and removes your bank discretion over maturity effect. Then we go into advanced RB approach, which is the full bank estimation. Bank estimate your probability of default, loss given default, exposure default, and M, maturity internally. This represents the highest level of modeling sophistication under Basel II. There's a PD floor. Probability of default may reflect trade mitigants like your triggers, your guarantees, but remains subject to your 0.03% for your 0.03 floor for your banks and corporates. And again, this ensures prudence and comparability. If you look at LGD, loss given default is driven primarily by collateral quality, and the seniority of the debt. And when you look at the seniority of the claim, that is very important. This aligns LGD, loss given default, with your actual recovery economics. And we have the EAD flexibility also. With supervisory approval, banks may use your internal credit conversion factor, and this will allow a better modeling for your drawdowns, your undrawn commitments, and your behavioral usage pattern, right? So that is what we try to understand. Then the next one is your topic number 9, which is your IRB approaches for retail exposure. Uh, the whole idea is merging a foundation and your advanced IRB for retail exposure. Basel II does not distinguish between your FIRB and AIRB. Banks provide their own estimates of probability of default, your loss given default, and exposure default. This reflects your high data availability, large number of small homogeneous exposure, and no maturity adjustment, right? So that's what we need to understand. Maturity adjustment does not apply to your retail exposure. Reason, retail portfolios are granular, credit risk is less sensitive to maturity in aggregate. And then you look at the capital requirements, please understand that capital per exposure is EAD into LGD into DR, default rate 99.9% minus PD, right? Expected loss is removed, capital targets unexpected losses only for the capital requirement. And you go into the risk weighted asset is 12.5, which is 1 divided by 0.08 into your EAD into LGD into DR 99.9 minus PD, right? Then you look at correlations, lower correlation, retail exposures are assumed to have much lower default correlation than corporate. What it means is that individual household defaults are less driven by your common systematic shocks. Lower correlation means lower default rate 99.9%, lower capital. That's what we need to understand. Okay. Then after studying this, we go into your operational risk capital requirements. There was an introduction of operational risk capital. Basel II is the first Basel framework to require explicit capital for operational risk. Operational risk include your internal frauds, internal failures, rogue trading, like your Baring Bank, external events, fire, system outages. This closes a major gap in your Basel One. Three approaches here also under your Basel Two. One is your basic indicator approach, which is the simplest of method. Capital is equal to 15% of your 3-year average annual gross income. Gross income includes your net interest income, your non-interest income. Years with negative gross incomes are excluded, designed for small or less sophisticated banks. Then we have the standardized approach, which is similar to business indicator approach only, but different business lines have different multipliers. Reflects that operation risk varies across activity. Trading has different risk, retail has banking has different risk. And then we have the advanced measurement approach, AMA, most sophisticated method, uses 1-year war at 99.9% confidence for operational losses. Similar in spirit to your IRB for credit risk, banks may incorporate your insurance, your risk controls, internal loss data, requires strong governance and supervisory approval. Okay, that we need to understand. Then you look at practice question number 2, right? Which accord first required banks to hold capital for operational risk? Your that came in your Basel II, right? So Basel I was credit risk only. 1996 amendment was your market risk only. Basel II was credit, market, and your operational risk. Solvency II applies to insurance, not your banks, right? That we need to be very, very clear. Okay. So this is what is your answer. So Basel II require banks to maintain your capital for operational risk. Bank can use 3 methods to measure operational risk: the basic indicator approach, standardized approach, and the advanced measurement approach. Okay, that we need to understand. Once we have understood this, next one is your understanding of your Solvency II framework. Please understand the scope of this. See, Solvency II, when we talk about, governs your insurance companies, not your banks. Covers your operational risk, covers your investment, your market and credit risk, your underwriting risk, life, non-life, health. There's a capital structure here, 2 capital threshold. One is your MCR, which is the minimum capital requirement, which is the absolute floor. SCR, the solvency capital requirement, which is the total capital. SCR sits above your MCR. Approaches to SCR is that there is a standardized approach designed for insurers without advanced modeling capabilities, uses standardized risk factor, cost efficient and conservative. Then there is the internal model approach also, which is similar to your Basel II. Internal rating based approach uses 1-year war at 99.5%, right? Please remember this. You are using 1-year war at 99.5% confidence, lower confidence level than your bank, because insurance liabilities are long terms and more stable. Risk covered are your underwriting risk, your investment risk, your operational risk. And then there are capital tiers also, that 3 tier structure similar to Basel. Tier 1 is your equity return earnings. Tier 2 is your what you say liquidation right of liabilities. Tier 3 is your other policyholder subordinated capital. And then you look at the internal model test. Insurance firm must safely kind of satisfy your statistical quality test, your calibration test, your use test. Model must influence your business decision. That we need to understand. Okay. With this, we move to the question here. Which of the following statement is correct, right, regarding your capital requirement for insurance companies, right? So when you look at your statement, Basel II includes the regulation of banks and insurance companies. Please understand that Basel II is for bank, not for insurance company, right? The minimum capital requirement is likely to be higher than the solvency capital requirement for insurance company. No, MCR is actually lower, right? MCR is lower than SCR. SCR is higher, right? Then third one is the repercussion for violating the solvency capital requirement is likely liquidation and the transfer of company insurance policies to another firm. So liquidation is more likely for MCR breach, not your SCR breach, right? So SCR is generally higher, right? MCR is the problem, right? So this is also wrong. Now, what about D, right? Uh, the internal model approach to calculating the solvency capital requirement is similar to your internal rating based approach under Basel II in the firm that calculate VAR with 1 year time horizon. Right. So solvency to internal model resemble your Basel II IRB, both require 1 year VAR. There's a difference. Banks have Basel II 99.9%, insurance solvency to 99.5%. So please understand that solvency to internal model resemble your Basel II IRB, right? So that is very clear, right? So remember, answer is D. Okay, so that we understand. Fine. So this is what has been given solvency to, not Basel II, right? Uh, Establish your capital requirement for insurance company. The minimum capital requirement is just that at true floor, right? The precaution for MCR, like the prohibition from taking new business, not the SCR. Right? The internal model approach is similar to the internal rating based approach in Basel II in the insurance company and calculating 1 year war with 99.5 confidence level versus 99.9% under your Basel II, right? So that completes our chapter, guys. Overall, always zoom out and look at the bigger picture. Basel II basically is banking focus, extreme tail 99.9%, unexpected losses centric. Solvency 2 is insurance focus, slightly lower tail 99.5%, liability aware, right? Kind of framework. And both framework converge on your risk sensitivity, your internal models, your governance and supervisory oversight that we need to understand, right? So that completes our chapter, guys. Let me give you a quick kind of this is a long chapter, right? Let me give you a quick uh, recap, right? Quick recap before we stop, right? So what we can do is we can go to the start and start again. A quick recap: where to focus, where not to focus. I think that will add a lot of value if you look at it from a zoom out perspective, right? So again, the chapter was capital regulation before the financial crisis. Lot of theory, right? Some formulas also there, but lot of theory. You need to understand the logic behind it, right? So two module: Basel I regulation and revision, Basel II regulations. Important topics: try to understand two, three methods here, which are very important. Try to understand how CEA is calculated, what is how original exposure method is calculated, how RWAs for on balance sheet and off balance sheet are calculated, right? What are this different amendments? What changed here? Just have an idea for back testing also. What is the thing? This is what initial part, your overview, your you know need overview, need BCBS, capital risk weights, two capital component. These are not so important, right? Not so important, right? Not so important. These are important, right? These are important. Okay, keep that in mind. Okay, so this is what is important here. Then you can see the numericals, etc. Now, if I go to your module 2, right? In module 2, again, uh, this is actually more important, right? From the exam perspective. Obviously, Basel 2 overview nobody cares about, but please understand these three pillar: pillar 1, pillar 2, pillar credit risk, right? These three are important. So these three are important, right? Then credit risk capital requirements under all approaches, under your standardized approach, under your internal rating based approach, advanced IRB, FIRB for retail exposure, and operational risk capital requirements, solvency two. These are all important, right? So comparatively, module two is more important than module one, right? And you need to know the small specific things, right? If you don't understand small specific things, uh, you will be in trouble here, because the question asked here are very specific in nature, and you need to know the value. Like for solvency, the 1 year war is calculated with 99.5%, not your 99.9%, right? So small things matter a lot right here. Okay. But again, we have covered everything what is required or part of your syllabus, right? Go back, revise it, understand it, focus on remembering key things. See, Basel is very important. Wherever you see Basel, in FRM, whether it's FRM part 1, FRM part 2, right? This is very, very, very important. You need to have absolute clarity about Basel, and especially if you come to FRM part 2, right? You need to know very, very fine points about Basel, right? That is what the objective is, and examiner will definitely test it, right? So your notes include everything. I have explained everything. Only duty is you have to go back and revise and remember. That is what you have to do. So best of luck for that. If you have any question, shoot your question, ask me. I'll try to help you as much as possible. But go back, revise, and remember. You have to do multiple revisions because these theoretical things doesn't stick to your mind so easily, right? So you have don't rely on only one revision. Try to have multiple revisions to understand it better. Okay. So that's it from my side, guys. Go back, revise it, and I'll see you in the next lecture. Okay. All right, guys. Thank you.